Good evening, everybody. Good afternoon, whatever it may be. This is Mike. Hope everybody's doing well in this market. And today we're going to talk to you about different strategies and how I basically negotiated this market this year, and what I've done and what I haven't done specifically, because you're looking for different things here, right? You don't want to just deploy money for no reason. And the best way to start this when we go looking at the strategies to look at the S&P 500. That is the benchmark for the indexes, right? This is the 500 of the top stocks. This is the biggest one. This one usually shows us the big move in the markets. And as we're doing this, here we're at all-time highs, and the market's holding in strong with a nice upper level flag. But to really tell the tale of this tape and where my strategy evolved from this year, you kind of have to back this up to last March. And so we're going to take a little stroll back in time here to last March when we had this big, you can see it in here, 30% correction in the markets. And there's a reason I'm bringing up the 30% correction, because since that event ended last March with COVID, we have yet to have a correction in the S&P 500. Now, have we had little pullbacks? Yes. Have we had some chop? Absolutely. But we haven't had a correction being at least a 10% down move. That's kind of interesting because typically you get 3 to 4 of these in a year. We're way overdue for one, and the sentiment in this market is extremely bullish. So these are the type of things that sometimes give me worries, right? Makes me pause. So what am I this year? One of my thoughts was I wanted to deploy heavily, got some big time in cash into a correction that we have yet to get. So, don't feel bad. You're not the only one looking at it. So let's just start back in time. And off our March lows, we had this big move up until we came into this pullback zone. And if you come back into the period from last September up until the beginning of November, we had this choppy W pullback zone where we pulled back about 5 or 6%, never got down to a 10% correction in the markets. Ultimately, you can see we held the 100-day moving average in here. Market remained very strong. And at that time, we were coming up on a big event in the United States, and that was the presidential election. And the market was extremely concerned at that time about Trump losing, Biden winning, and what would happen to control of the House and the Senate. And the market, if you look at the action going into the election, led us to believe that it wanted to sell off because it was nervous that Trump was going to lose. Funny thing happened on that. As the market was selling off a couple days before the election, the market decided, no, I'm not selling off. I'm going to start running. And we actually started to front run the election and then ran all the way up into the turmoil period where we didn't really know who was president for a week or so, right? It was about a week or so before we actually knew who was president. So this here, and the reason I'm pointing this area out, and here we could put it in a little box here. Oops, hate when I do that, right? Right in this area. The reason I'm pointing this out, because this represents the biggest corrective type activity we've had in the S&P 500 since last March. Is this bad or good? Well, it's good if you're a long-term investor and you're holding stuff. From a trader, it's not so great. And for markets, it's not a great thing. Pullbacks reset these setups in the markets. They also bring things back into more alignment. Right now, we're looking at valuations starting to get stretched in this market. So after this run up in November, and then we had this run again. Let me remove this for you. Okay, we had this nice long run up into the end of the year. I decided that I was not going to deploy cash until we got a correction. Well, it's now end of April, almost May, and we've yet to get any kind of correction. We've only been able to get a 5% pullback in this market. Very, very frustrating. So my strategy this year was to sit there and sit in mostly cash and day trade or short-term swing trade. And that's what I've been doing. And if you look at the S&P 500 here, you can see the incredible strength that we've had for this year. This red line represents the 21-day. You notice how few times we've been below that. This line right here represents the 50-day. That actually has acted mostly as support. At this point in time, you can see now just how extended we are starting to get off of everything. And what that means here is that the market is starting to get into a very extended zone. We are well off the 200-day now, which is down here at 362. The 21-day all the way down here, also pretty far off of it. And we've left a bunch of small little open gaps behind as we continue to move up here and flag. Now, does this mean the market's going to come in? No, it doesn't. Markets can stay irrational a lot longer than most people can stay solvent. That's one of my favorite sayings. If you think about the Big Short, that movie, how many people, these guys who were trying to short the markets back then and short because of the rates, they almost all went insolvent before the market finally came in. They made a lot of money. But you have to be on guard here, and you have to be aware that we've moved way too far, way too fast, and this market's getting extended. Valuations are getting extreme. Okay. So how do you handle a market like this? Well, you have to watch for the rotation setups. And if you look what's going on and we go back to the Qs and tech, we have a very, very different chart that emerges. The Qs are just shy of all-time highs today and just starting to come back up. And in the Qs, we actually got a 10%, briefly, a 10% correction back here in the beginning of March timeframe. What's been going on in this market is we've been seeing a lot of rotation throughout the year. And if you look what's going on, tech is just starting to come back into vogue now as we go into one of the busiest earnings weeks of the year. So, this is shot a couple days before you're going to see it, but this is the week we're going to have names like Tesla and Apple and Google and Microsoft and AMD and Amazon, big, big tech names reporting this week, which are really going to help decide the fate of this market, where it wants to go. So when you look right here, you see on the Qs, you have a very interesting pattern. You're not as extended. You're not as overbought. You have a cup and handle formation that's formed here right at all-time highs. And the market's saying, okay, maybe we're going to rotate back into here. Let's look at some other charts. What really led us for most of this year was the value plays. What do I mean by that? You go into small caps, financials, diamonds, big stuff. We'll look at this. But look at this move in the IWM. And if you back this up, the IWM took forever to get back to the 52-week high, and it had been lagging for years. So when you look at this chart and you take note of what happened is once we came out here and we gapped up, and I want you to notice what we did. You see this high over here? Let me go put some box in here for you. Right? Notice this area right through here, right? This was the previous 52-week high there. We gapped up into it, above it, and held it, leaving an open gap below it, showing incredible power on that move on that day. And once that happened, this blue line represents the 8-day moving average. You can see the change that took place. No longer was tech leading, right? Back in November, no longer was tech the big leader. Now it was small caps, and the small caps ran. Barely pulled back, touched the 21-day, ran again, pulled back, held the 21-day, ran again. It wasn't until we got into February where that rally slowly decided to fizzle out. And here we are today, right, after this big move. And you can see now we've created this kind of consolidation range on the Qs. And you can come in here and say, right now, I'm sorry, on the IWM, we're in a channel, right? Basically sitting here going sideways in a channel, consolidating. And consolidation is good, right? Consolidation allows things to catch up. And you do have a little head and shoulders top pattern here that's developed, but it hasn't really triggered. And this was the leader. So for most of this year, small caps were the leader. Starting in February, small caps suddenly became weak. They started to give up the ghost. What else ran? The financials. Look at the move in the financials. Again, another one, gapped up, took off, huge run. So we've seen in this market constant rotation year in and year out. And right now what's happening is the ones that led us all this year are starting to tire out. The IWM, the financials have gotten tired. You switch over, you look at large caps, the diamonds, the industrials, right? Look what's happening here. Diamonds also led, getting tired up here, going sideways. So we're starting to see a change in character in this market. And this is where you start to ask yourself, what's next? Who's going to lead next? Is it going to be tech and the QQQs? Right? We've looked at that. Are we going to see this become the leader? And certainly the Qs are poised. They're not as extended. They could lead, especially if earnings are great. Is it going to be the semis? With all the talk of the chip shortage and everything, isn't it interesting how the semis have yet to hit the all-time high that they put in back over here, back in February? So the semis could poise to lead. And I don't know about you guys. I love when the semis lead. So what this market has done this year is has rotated sectors and areas and moved on to different ones. So it's created a very, very wild year. So coming into this year, my strategy was to deploy big cash, and I do have a lot of cash I want to deploy into a correction, which we have not gotten. So my process became at that point, I'm going to day trade and I'm going to focus on short-term swings and names that are in play. And what I like to do that is I use a couple different things. One, I look at technical setups on a daily basis. The other thing I look at is volume in the name. And then the other one is option flow. These technically tell us whether a name is in play or not. And one thing this market has been very good about through the entire move up is giving us names to play every day. Even when the market has weak days, generally there's money to be made to the long side because this market's still so bullish. Names are very strong. Even when you look at the spot S&P 500 on last Thursday, we had that big weekday, right, on the news of the possible 40% plus on the capital gains tax. There were longs to be had that day. So I have focused almost primarily on looking for names in play and trying to find the strong names and where to go. And that is something that, I think will serve a lot of people. Look for the strong names, look for the great setups, look for what's in play. And, if you look around the market, you can see, and if you start looking at charts, you can see there's been different names to play in different, no, it's not GME, one letter too many, GE. So, GE was one of the names that was on my radar this year. And, you can look here on this chart and here, if you look in here and you just kind of look at this here, on these days here, look at the volume candles, right? Here's your average volume. It's so low down here, right? The low volume. Look at the wake up candle on these days and this push, right? Day one, day two, beautiful move in this name, beautiful move higher. Day three was a gap up and pulled down before it came back and pushed up. So, if you're watching option flow, you're watching volume in the names, it's going to tell you what's in play that name. And that's really what helps out. Now, the technical setup was here as well, right? You had pulled up, pulled back, was riding the 8 and the 21 day. I love when names pull back and hold the 8 and the 21 day. It shows incredible strength there. So the name was set up, and all it needed was the fuse to be lit. And that came here on this day, on the January 11th, took off, 1, 2, 3 day move, could have gotten in and out of it, pulled back, went sideways, created a gap and go for another 2 days before it finally came in, for eventually getting all the way up here to here. We're going to probably come back and focus on GM a little bit later. So lots of names have been in play this year, depending on what you're looking for. I know you guys all love Tesla. Tesla's very good at signaling days when it's in play. You look back, you look at the volume on the candles. You can see the size of the moves, whether it's the upwards or the downside. And you look at the volume setups here on this day, on January 7th. Look at the size of the candle that day. Whether it was the volume there, sorry, the 6th or 7th, yep. Okay, volume, not great. One of the other things I always look for is options flow. When they want a name, they come all over it. So in recently names, ideas. I know a lot of you guys like to play with these little names like Clove. This name is fabulous for telling you when it wants to be played. All right. On this day here, made nice money on Clove. Why? The volume was off the charts within the first 10 minutes of the day. It was already at like 20% normal average daily volume, and the call buying was through the roof. And that's what you love when you can see that coming in a day like that. They just come for the name over and over again. They're hitting options, multiple strikes, multiple expirations, at the money, out of the money, all over the place, telling you that name's in play and they want to be involved in it. And then it gave another day of follow through. So for me in this market, my strategy, very, very simple, guys, is to focus on good setups that have volume and have option flow. One thing I do try to avoid is trading names that can get me in trouble in a market like this. Names that are very loose, names that do not have good liquidity and options, and the spreads are wide and they don't trade a lot of volume. So many people constantly talk to me about CMG, and I love CMG as a company. I think they're a great company. I love their product. But for me, this name trades now a couple 100,000 shares a day. So it's not touchable with stock. On options, most strikes sometimes, one thing you can tell you about CMG is when you go out and you look at the option flow in it, and here's a tree for you guys, right? when you can see your order, right? If I was to buy one of the April 1480 calls, the April 30th here, you would see my order tick here. You never want to be able to see your order unless you're a big fund. That's different. I'm talking about, your home or whatever. If you can see your order, there's no liquidity. You have $5, $4 spreads on the names, right? There's no liquidity. It's very hard to get in and out of these options. So one thing I also focus on times like this, when the market refuses to pull back and I'm not comfortable sitting in a lot of positions, is avoiding names like CMG, which can be difficult to get in and out of. And you can lose a lot of money very quickly because you can't sell. Remember, the market maker doesn't have a buyer on the other end. They're going to really hurt you on the way out. They'll just keep dropping the ask and the bid and dropping the bid to get out of it if you're in calls, or opposite on puts. So very difficult. And the thing is to focus on names you can trade and to look what's in play. So for me, sectors very specific. What sectors are in play? Where's the money flowing? What's been in play? What's moving? And then you look to see, are we extended? And the one thing I always tell everybody is when you're trading things like the financials or the SPY, is these never like to get that far off the 8 day. Anytime you start to get close to that, well off the 8 day, like if you look at the XLF right here, all right, the blue line being the 8 day. You see this day when we opened up here this far off the 8 day, that was a no-go for me. I'm not going to take it. The risk reward now changes out of your favor, meaning learn your stocks. For me, the 8 day moving average is gold. Some of you guys like the 9, some of you like the 10. Use whichever one you prefer. I like the 8 day the best. But whenever you get this far off of the XLF, you're asking for trouble. You're asking for trouble, and chasing it at that point is the risk reward is no longer in your favor. If you're patient and you want to get in it, you wait till it comes down. You had 2 day pullback, went below the 8 day, then popped up, and then it gave an entrance when it took out this area up here, or anytime it touched the 8 day in here. And that's what you have to do, is look for, saying, try not to chase these names as they get very extended. The S&P 500, very, very similar. When this name starts to get extended off the 8 day, like this day here, when you're over 10 handles off the 8 day moving average, that is not the time to be chasing into anything there. Notice what it did. It gapped up, closed, and then it spent a couple days going sideways, allowing the moving average to catch up before starting to push again. So little tricks like this in a market like this will help you. Now, when you have something different like this and you get this big move, right? Right down here, again, bring it to your highlighting, to your attention, right? Nice move. First day took back the 8 day moving average. Second day popped higher. Day 3, day 4, wildly extended. Day 5, inside day. Day 6, I don't remember the reason here, huge gap up. I mean, this is if you're a swing trader or a day trader, you're taking profits, maybe cute shorts if you feel it, but you're not chasing in this action, right? At that point, you can look where 347 was the 8 day, and we're up here at 364. To me, little things like this, guys, may save you a lot of problems as we move forward in the market, especially when the market starts getting choppy like this. So again, my strategy for this year is wait for a correction to deploy heavy cash into and take big time swings in long-term positions. And secondly, is to sit here and to make sure not to chase names that are extended. Day trade, swing trade, take good setups with technicals, good volume, and that works out very well. So let's talk about a couple of trades that worked this year and some that didn't. So let's start off with really what turned out to be a fabulous trade, and that was in Gilead this year. So Gilead, right here, we got long calls in my room here on this day, not on the bottom, probably about halfway up it. We got long, and we went out. I believe it was the June 570 calls. June 70 calls. I have to go look. Let me go see if I can pull that up for you real quick. I think that I always keep it, by the way, always keep a trading log. I keep a log of every trade I have. I do. This way I can find it. It's in my hair. It was the May 6750 calls. So we got long the May 6750 calls on this candle. Notice it was right at the very end of December, the last day in December. Plenty of time. When I want to swing and I want to be able to sit in something, I'm not going to dink around. I want time. I want time to take advantage of the move that may come so I can maximize my investment. Okay, so what happened here? Day 1, beautiful day 2, Inside day three and day four went. Day four, you notice we pushed up here into the 100-day moving average. On that day, I think I sold some. For the first time, I started taking some profits. We went sideways and chopped around for a while. Then we gapped up and got another big move. Again, up close to the 200-day. At that point, somewhere in here, I sold out of all my calls. And you're saying, Mike, why'd you sell out up at 67 area? Well, because we come into an area of resistance. The 200-day moving average identified could be a problem for this name. We're also in an area of decent volume. I said, this may have a problem getting through here. Pull back, pushed up a little higher, ultimately pulled back and has been going sideways ever since. So that was a nice trade. That was a nice swing trade that lasted about a month. Nice one to be able to sit in. And the gift and the key of that was having time. Another thing I'm always going to tell you guys is very simply take profits as you go. You don't need to do all or nothing. You can always get back in. You can always add calls back on a pullback or stock back. If you're constantly moving, you're shuffling your feet and you're taking some profits, you can't get hurt as badly. Put a profit stop in place. Once I was up nicely on these calls up in here, I had a profit stop. I wasn't going to let this trade go red, and that's something that's very important. Too many people just sit in things and they just say, oh, well, it expired worthless. I very rarely let a call, an option play expire worthless these days, because why give them the money? 50% stop, profit stop, good enough for me. Okay, let's talk about a trade that did not go so well. And this one was recently. Walmart. Boy, Walmart is quickly getting on my do not touch list. This name is just driving me nuts this year. So on this day right here, we had a big push up. There was news, and they bought a ton of the May 150 calls. So me being who I am and saying I like it, I decided to go in and buy some of the May 150 calls because I like the move, specifically because you had this gap sitting here that could be filled. I'm like, yep, they're playing for that gap fill. They're playing for a move up here to uh, Trendspider puts at 144. I actually treat gaps differently than most. I don't treat it as the bottom of the candle. I treat it as the open to the close. So I saw a possibility for a move all the way back up to the 148 area, close enough for the 150s. Just a different perspective on things. For me, a gap is from the open of one candle to the close of the close of one candle to the open of the next. So I treat things a little bit differently. That said, what happened is we came in here and we started pushing in and pulling out and pushing in, tested the 200-day, held, pushed up, went below the 200-day. At that point, I finally got tired of this trade and said goodbye, only to see 3Ds later put back into the gap. Now, the calls never really got profitable, and here you're out. So something else to learn. Why did I get out for a loss here? I took a small loss on it, not a huge deal. Because if a trade is not working, there's no reason just to sit in it. And that's the one thing that I've encouraged you guys all out there to start thinking and looking at. If you're in a name and it's not working and they're chewing your option premium, get out. Now, if you're in a stock and you don't care, that's a different story. But if you're sitting in options, don't let them chew your option premium to shreds. That's your money. Get out. Set an alert. Set an alert of where to get back in. So, in Trendspider, you can come in here and create an alert right at the gaps, right? And say, come up here, a touch of the gap, during the session, or you can even go down to, like I usually go down to a 10-minute chart or less, and just say, okay, just tell me. So I'll get an automatic desktop notification. Now I know I have an alert in there. That's when I would want to get back into Walmart. Plain and simple. At this point, this name is dead to me until it gets back up to that gap. There's no reason for me to get into it. Even today, they bought a ton of the weekly, the May 14th 141 calls, and it's closed near the lows. I have no interest in it. So remember, not every trade is going to be a winner. Not every trade is going to be a loser, a great trade. But it's about managing your trades and doing well as we wait for this market to finally pull back. And at some point, this market's going to correct, guys. Anybody out there and you see on people on Twitter or FinTwit saying this market will never correct again, the market can't correct, please don't listen to them. They don't know what they're talking about. Markets always correct. This will happen. Just be patient. So let's talk about some things I'm looking at when we do correct. And I'm going to give you a couple different names here because these are things I've worked on all year long and I've talked to my members about. And I did actually every year I do an outperform list for the name for the year. And GM was one of these names on my list. And it took off right here back in the very beginning of January. Didn't even get much time to get into it. And I love what's going on with GM. I love the story here. I love how they're setting themselves up. That said, I do not want to buy it up here close to all-time highs. Where I like this name now, if we get a pullback, is I would start considering if the market corrects and it holds into this 48 area, 49 area, I would look at it there. And then I would really like it even more if it came down here into this 46.50 area and topped off on this candle. So if it came down to here and we get a market correction, I would be looking heavily at a name like GM there. I think that could be a very good name as we move forward. Not to be outdone, um, I want to have some exposure to EV names other than GM, and I'm thinking Lithium or LAC. So what you need to know about these names, why lithium for me? Lithium for me because everybody's going to need, every car's going to need lithium batteries, right? And that's going to be a huge amount of money going into that as every auto manufacturer goes out to that. So lithium already starting to wake up. Again, market gives a correction. This thing can come down. You look at the volume shelf, you may be able to get this thing all the way down here around 11 or 12. That would be sweet. I would love to pick up LTHM around there. The other one I really like in this space is LAC. What you need to know about LAC, and this is important, is LAC is pre-revenue. They will not have revenue to next year. So this is a much more of a speculation play. And what I mean by that is, think about that. This could pull back. And if the market corrects, for me, this one, anywhere around this 11 area becomes an extreming buy. Again, it got close here last week. I had to trigger on it. I'm trying to wait for a correction. Really like this one moving forward. I think this could be a big winner as we go forward as well. Some different thoughts on playing the EV space rather than chasing names like FSR, which has no revenue for at least another 18 months if they make it that far, right? So just trying to change the thought process here for you guys. One more, give you guys three to look at. Intel this year was a name I loved in January. I thought you could buy it versus this 45 area low. Unfortunately, it didn't wait. It took off beforehand thanks to some activist investor getting involved in it, pushed up, gapped up with the new CEO, and you got this big move. Okay, so now we just had earnings and you have a new gap that's developed here and you're getting the beginnings of a corrective phase. I like the long-term story in Intel. If you get a correction in this market, here's what you watch for. You see this big void in the volume profile here. If it drops down, it can come all the way down to 50. If you can get it down around 50, that's a place I would look to try to enter into Intel for a long-term hold and trade. So guys, my name's Mike. You guys know me. I'm out there on Options Mike. My website is smartoptiontrading.com. I run a Discord room with Zoom and private Twitter feed. Every day we're looking out. We're looking for volume. We're looking at the options flow, the news, what's in play, and the technical setups. We do this Monday through Friday. Very welcoming community. They're very helpful for new traders. They have a lot of very experienced traders in there as well. Would love to have you guys sign up with me. You can visit my website and join me or follow me on Options Mike. I post so much stuff for free out there, including a free video every week. Thanks for joining me and turning this back over to Jake. Catch you guys soon.